Welcome back to the Global Ledger. I'm Justin. In episode 22, we broke down the role of primary dealers, the market makers that link the Treasury market and the Fed and global dollar demand. Today, we zoom in on the institution that has quietly taken over one of the most important functions in the entire financial system, and that is money market funds. I call these the new banks. If you want to understand modern liquidity, collateral cycles, repo markets, or why trillions of dollars now sit in cash-like instruments instead of traditional deposits, then this is the episode for you. Let's get into it. Why money markets and money market funds matter now. So money market funds, MMFs, how they're recognized, are not banks, but they increasingly behave like them. They hold treasury bills, they hold repo, they hold agency debt, commercial paper, cash-like instruments. They provide liquidity transformation, maturity transformation, cash parking, a safe alternative to bank deposits, and they do so outside the traditional banking system. This is why they're considered part of shadow banking, not because it's illegal or hidden, but because they perform banking-like functions without being banks. So the rise of MMFs really are a response to regulation and market structure. So money market funds exploded for three reasons. Number one, regulation pushed deposits out of banks. Post-2008, regulations increased. Liquidity requirements, capital requirements, and restrictions on how deposits could be used. So banks became less willing to support certain types of short-term cash management. And MMFs filled the void. So number two, institutional cash needs grew. So corporations, asset managers, insurers, and sovereign funds needed high liquidity, low risk, daily settlement, market yields. Deposits didn't offer that. Money market funds did. Number three, the Fed's tools unintentionally supercharged these MMFs. Two big catalysts. Number one, overnight reverse repo facility. The Fed pays MMFs directly for their cash. This gave them a risk-free floor yield. B, interest rate volatility after 2022. T-bill yields soared. MMFs became extremely attractive. MMFs are now systemically extremely important. So today, MMFs manage over $6 trillion in assets. It's the fastest growing major financial product, and it's more than the bottom half of the whole U.S. banking system. They are now liquidity providers of first resort. They absorb cash during stress. They are now treasury market demand anchors as well. They are the marginal buyer of bills, repo, short-dated collateral. Key players in the global dollar system. Foreign institutions also use MMFs as synthetic dollar accounts. So why are they called the new banks? Money market funds replicate the economic function of deposits. As an example, you put in $1, you get back $1. Instant liquidity, short-term safe assets, stable value, NAV around $1. Cash management for payments, parking idle cash. But unlike banks, they don't make loans, don't use fractional reserves, don't take balance sheet credit risk, aren't backstopped by FDIC. Instead, they channel cash into repo, treasuries, bills, the Fed's overnight RRP facility. So instead of creating money, MMFs redirect money into the safest, most liquid instruments in the world. This makes them cash warehouses, not credit creators. But to the depositors, they feel identical to a checking account with yield. So what's the hidden risk? They depend on the Fed and Treasury market. MMFs are stable because their collateral is stable. Their repo markets are stable. Their T-bills are stable. And the Fed guarantees the floor yield. So if Treasury markets seize up, they seize up. If repo fails, they fail. This is why the Fed had to intervene in 2008 and again in 2020. And it's why the Fed now designs policy with the existence of MMFs in mind. MMFs are reshaping the financial system. Here's what their dominance means. Number one, bank deposits shrink permanently. Cash goes to MMFs because they offer higher yields. There's more safety, better liquidity. Number two, Treasury bills become the new money. Bills are now the closest substitute for deposits. Number three, the Fed's overnight repo facility, ONRRP, is what it's called. It becomes a structural pillar. It anchors short-term rates and creates a safe place for trillions of dollars. Number four, the U.S. government becomes the primary short-term borrower. MMFs fund Treasury deficits, not private lending. The line between public and private liquidity also blurs. Money becomes increasingly government-backed. So what's the big takeaway here? Money market funds are no longer a niche product. They are the new cash infrastructure of both U.S. and global finance. They don't replace banks. They replace the deposit function of banks. In future episodes, we'll look at how this shift affects bank balance sheets, Treasury demand, Fed policy, liquidity cycles, global dollar flows. But for today, just remember, if you want to understand where money goes in the 2020s, follow the money market funds. Money market funds don't just reshape liquidity. They subtly reshape asset pricing and valuation across global markets. And here's how. Number one, MMFs anchor the short end of the yield curve because they hold T-bills, repo, overnight RRP, short-term government instruments. They determine the marginal demand for the safest assets. This in turn affects Treasury bill yields, repo rates, dollar funding cost. And since the short end feeds into valuation models, MMFs influence the risk-free rate. When trillions flow into money market mutual funds or money market funds, bill yields fall. The risk-free curve starts to shift. Discount rates adjust across all asset classes. So number two, MMFs tighten the spread between cash and risk assets. When MMFs yield, say, 4 to 5%, investors demand higher premiums from equities, credit, and real estate. Risk assets must compete with a stable, liquid, government-backed alternative. This compresses valuations when yields rise and expands valuations when yields fall. MMFs indirectly set the hurdle rate for taking risk. Number three, MMFs steer liquidity toward the public sector, not private credit. Because they mainly invest in bills, repo, Fed facilities, MMFs funnel cash into safe government instruments. What this means is that there's more liquidity for treasuries, less liquidity for private credit, and wider spreads for riskier borrowers. That shift changes the cost of capital, the pricing of corporate risk, the valuation range markets would consider fair. Number four, MMFs amplify the impact of Fed policy changes. So when the Fed tweaks administered rates, MMFs move billions within hours. Funding spreads shift, risk premiums update, valuations respond immediately. The feedback loop between Fed policy, MMF flows, short-term rates, discount rates, asset values is now one of the most powerful mechanisms in the financial system. So money market funds aren't, say, passive cash pools. They directly influence discount rates, risk premiums, and valuations across global assets. They are really now a central pillar in how markets price risk. So thank you for listening to episode 23 of the Global Ledger. Today, we looked at how money market funds have quietly become the new cash infrastructure of the global financial system, holding trillions in short-term instruments, anchoring the front end of the yield curve, and reshaping discount rates and risk premiums across markets. They don't function like old school banks. They function like public-private liquidity engines, channeling cash into government-backed assets and influencing the valuation landscape really from the bottom up. In the next episode, we continue building out the institutional architecture with episode 24. We're going to talk about pension funds and really call them the slow-moving giants behind global markets. We'll break down how long horizon investors shape supply and demand across risk assets, why their rebalancing drives market flows, and how they interact with the dealer and money market ecosystem you've learned so far. Once again, I'm Justin, and thanks for being here.